Hello, everybody. Welcome to UFile's Facebook Live session for today. As you know, we will be answering your tax questions live on air. And simply put in the comments, you could type in your question, and please be detailed in order for us to answer it correctly. I'm your host for today. My name is Ida, and to answer your questions, my colleague Jerry Villaratis. Hi, Jerry. How are you?
Not bad, Ida. How's everything?
Pretty good. Pretty good. How is it going today? Busy?
It's tax season, right? So it's always busy. I mean, that goes without saying. It's
Hmm.
always really, really busy and everything. So as usual, I mean, it's picking up now because now now I think people have gotten their slips, right? I mean, pretty much everybody has all their tax slips by now because usually every emitter has to submit them by February 28th to the CRA, and then of course it takes about 2 weeks before they trickle down to everybody else. Uh,
Hmm.
so. Um, so at that point, really the season is now picking up now. So now it's really starting. It's really getting going.
Perfect. Yes, Thomas, we thank you. And yes, we can answer your question. Just be specific for each question you ask us. You don't have to put them all at the same time.
Yeah,
So go ahead, ask us your question.
yeah. Andre is an old friend.
Okay. Andre, his first question is: when completing a T2125, under what circumstances do you have to fill out a GST 370 form?
Okay, so normally you wouldn't be filing a GST 370 because you wouldn't be getting any refund for what's called. Normally, you would be charging. You essentially within your expenses, you're including the GST and whatever QST. In your case, Andre, I think QST, or depending on the province that is in. Okay. Yeah. Hi, Andre. Yeah. Again, like I said, it's an old friend, so it's great to see you,
You could
Andre.
post a question.
Um,
Can you find it?
yeah, no, Andre. That's who I'm answering.
Yeah.
Actually, it's Andre again who's saying, and Az Jackman, hi as well. So so again, normally I believe the only time you would be able to claim a GST 370, meaning that you're getting a refund on the GST that you paid on your expenses, would be if you're in a partnership. Okay, if you're in a specific partnership. Otherwise, though, you don't collect that usually directly from the tax forms from the GST 370. It has to be as a partnership.
All right. Thank you guys for watching. I know you're saying hi to us, and it's our pleasure to answer your questions live. So if you have, go
Mhm.
ahead, ask us your questions.
Yeah, do not be shy. Go ahead. All right, I think we got another question.
Okay,
Okay, let's
Travis.
show that one. Here we go.
My employer has a group RRSP. They contribute a set
Hmm.
amount every month as well as a deduction from my paycheck for my contribution. My T4 shows what
Hmm.
they contributed for, but not mine. Where do I enter my contribution?
Okay, so Travis, in this case, you would enter it as an RSP receipt. Very simply, okay. You should, if they don't show up in your because it's a group RSP and not an RPP, then in that case, what that means is you should be getting an RSP receipt, okay, from whatever financial institution your employer is using to make the contributions. Okay, so keep in mind of that, and you just put it in as an RSP contribution. So go into the RSP section and plug it in as an RSP contribution. Now, be mindful though of the pension adjustment. Okay, make sure that you enter that in the software. Okay, the pension adjustment meaning that that is their contributions. That's box 52, your T4. Make sure to enter that in because that will affect your room, your RSP room for the following years.
Okay. Our next question is from Farida. Can I
Mhm.
use UFile to file taxes if I have over contributed to RSP by a few hundred?
Yes, absolutely. No, there's no problem there, and you're not in the over contribution penalty area. The over contribution penalty area is basically you're carrying forward your room plus $2,000. Okay, and if you go above that amount, then you're charged the over contribution. Now, what's going to happen though is that when you put the contribution in UFile is going to cap your deduction to your actual limit, and then we'll carry forward the excess amount to the following year. Okay, so that's essentially how that would work. Okay, so yeah, there's no problem there. There's no issue there whatsoever as far as you file.
Okay, our next question is from Keith Johnson. Why
Mhm.
do both UFile and CRA's websites show eligible RSP contributions for people who are over 71?
So Keith, that's a very good question, actually, Keith. And this part of a more advanced RSP strategy. Okay, the way it works is that even though you're not allowed to contribute to make new contributions past the age of 71, you're still creating RSP room beyond 71 if you're still working. Okay, so the limit and the actual contributions are two different things. Okay, if you keep working beyond 71, you're still producing limit. Okay, but you can't make new contributions beyond the age of 71. So you might ask yourselves, yeah, but what's the point? If I can't make new contributions beyond 71, why does the government still continue to tabulate a limit? And this is part of a strategy that you can use, which I actually mentioned in a UFile blog. Actually, if you go to our latest UFile blog articles, I mentioned this strategy directly. Okay, go to ufile.ca, go to the tips and tricks tab, and then go to UFile blog. And one of the articles, I believe it was seniors and taxes, we actually mentioned. No, it was the RSP article. Sorry, it was the RSP article that we just posted. Now I mentioned the strategy. What you could do is that the year that you turn 71, you can make an over contribution in the month of December if you know that you're going to continue working in the next few years. Okay. So when you do that, when you make that over contribution, as long as you know you're working and you're still creating limit, you can deduct that over contribution that you're going to carry forward to the future years. Okay. So that's part of a more advanced strategy, which, like I said, I mentioned quite a bit of in our UFile blog. So just go to our website. And actually, I'll try to even post the link for you directly on the page here. I'll do that now.
Okay, so let me know when you're finished so I could
Yeah,
read
let
the next
me
question.
let me go to it. And I'll post the link to our site with that article where I actually mentioned that strategy. So it's the importance of the RSP deadline. So here we go, and I will post it. There it is. All
Okay,
right.
our next question is from AZ Jackman. Hi,
Oh.
AZ. So, on the CRA's Twitter, they recently tweeted that we have to report any COVID-19 benefit money that we received. They
Mhm.
said that we were supposed to get a T4A for it,
Yes.
but I never did. So, how and where do I report my 2021 COVID-19 benefits?
Okay, so you're going to use a T4A either way. Okay, even if you don't have a T4A, you're still going to plug it into the T4A. So now I'm just going to tell you precisely which box to use. Just give me 1 second. I'm going into UFile now myself, um, and I'll tell you exactly the box number. So you're going to add a T4A slip, even if you don't have it. So that would be the pension income section of your interview setup. Okay, and then once you go to the T4A slip, you're going to see a line called Other Income or Other Information. Yeah, it's Other Information, sorry, which would be box 28 or code 28. And then click on the drop down menu. And the box numbers would be either from 202 until 04, depending on which one you got, whether it's a CRB, the CRB, or etc. It'd be one of those 200 boxes. Okay, so AZ, that's what you would use. Okay, that's what you would use. So even if you don't have a T4A, pretend that you got one. Okay, and just plug it into that same box.
Would he be able to see it on his my account from the CRA?
You know what? In theory, yes. And you know what? He should have gotten it though.
Yeah,
I mean,
obviously.
he should have gotten that slip. To be honest with you, so if he doesn't have it in hand, I get the feeling that even in my account he might not have it. But it wouldn't hurt to try. So what Ida's mentioning is essentially the My Account portal, right? Which is the website where you can go and check all of your tax information that the CRA has, including your slips, including your RSP receipts, including your carry forward amounts and your notice of assessments. Okay, so they're all there. So I strongly urge everybody who's listening to us right now to go ahead and apply for that.
Okay, our next question is from Andre, and it's very detailed. So,
Oh
okay.
boy.
Situation: Person X has a principal residence. After owning and living in it for over 20 years, Person X moves to a senior care home. The
Yeah.
son of Person X rents out the home for 12 months and then decides to move
To
in the
move
family
in.
home.
Okay.
I understand there would be two changes in designation in this case, plus a
Yeah.
776 for the
Yeah.
rental income and expenses
Yeah.
for the 12-month over two tax seasons. Now, his question is
Yeah.
A, can person X who lives in a senior care home still reclaim her home as a primary residence? If
Yes.
not, can the son, even if he doesn't own the home,
Own the home. Yes.
using a T
T
2091?
2091. Okay, the answer to the first question is yes, because well, the way principal residence works, and this we're about to do. We're actually about to post the video on it on our on our YouTube page. I'm editing the video, not editing, but I'm actually writing the script right now, and we're going to do a nice detailed video on our YouTube page. I'm being really I'm selling our content like crazy right now, but it's great content. I mean, I'm sorry.
People
Go to
are
our
asking
YouTube
the
page, everybody.
questions.
Yeah, I mean, go to our YouTube page, everybody. We have great tax content that actually answers quite a bit of these questions. Although this one is coming, actually, it's not there yet. We're going to be posting in the next
Mhm.
couple of weeks. But to answer your question, Andre, the first answer is yes, because as long the rule of principal residence is that it has to be, as the government calls it, ordinarily inhabited by either the owner or a member of their family, meaning the spouse or their child. And the child can be an adult. Okay, so there's no problem there. So yes, the elderly person can still designate it as their principal residence. The son in this case wouldn't get any gain because the son doesn't own the property. So if they were to sell the property later on, the son gets nothing because in the end the son is not an owner. So the son has nothing to declare as far as their return. Now the second question.
The second question is how would you handle the second change in designation with the capital gain? How do you calculate it if applicable?
Okay, basically it's not what's called the second, basically, what you have here is a change of use. This is what you have. Okay, you fall under the change of use rules. The moment you change the vocation of the property from a principal residence to a rental, you've essentially disposed of the property at fair market value as of that date. Okay, now there are elections you can take to defer. To defer in this case the disposition, but unfortunately, I'm assuming Andre, this happened in the past. Unfortunately, you're late on that designation, which means that the government can simply refuse it, or they're going to charge you penalties for it. Okay, so that becomes quite complex in this case. But legally speaking, what happens the year the elderly person moved to the retirement home and then the son was renting it out, that became a change of use. So as of that point, normally you would declare a principal residence. Okay, as of that moment. And then when the son moves in after the year, then you have a second change of use, which means another disposition, this time of the rental property. And this time you have a taxable transaction. Okay, you have to sell the property at fair market value if the property was being sold in the market, basically. Okay, and then at that point you could continue to claim it as a principal residence. Now, all this could have been avoided if the year the change of use happened, you would have elected under what we call subsection 45(2) of the Income Tax Act. And if the election was done on time, which was the deadline would have been the deadline of the year of the change. Had it been done then you didn't have to declare any disposition whatsoever, and you could have extended. So for the year of the rental, you could have still considered it a principal residence, even though you were renting the property. Okay, but unfortunately, I don't know if it happened or not, Andre. You'd have to check, to see if there's a 45(2) election already there. You could still elect under 45(2) late, but if the government can flat out refuse, or they'll charge you penalties if they accept.
Okay, well, long-winded question to
Yeah, well, it's a
answer actually.
complex
It's a
case. So.
complex, yes. Okay, our next question is from Evelyn.
Mhm.
I moved from Ontario to BC in 2021. I changed my
Mm.
address on UFile to province of BC, but kept my mailing address as Ontario. Why does UFile keep the Ontario benefits form and not convert it to BC benefits form?
Um, Evelyn, make sure that in your identification page you've clearly indicated BC. Okay, it's possible because there's two places where you're indicating your province. You're indicating your province first in the address, okay, and then second in the identification page where it says what was your province as of December 31st. Make sure that that is BC and not Ontario. If it is, and you're still getting those forms, then you have to contact us because then something else is causing a conflict. And unless I look at your file directly, it's very hard for me to determine why you're getting those forms when you're a BC resident now.
Okay, our next question is from Travis. For
Perfect.
2021 taxes, what date range do I include in my RSP contribution? My work's T4 RSP contribution only includes January 2021 to
Mhm.
December 2021.
Okay, actually, this one, the article that I posted, okay, the link actually literally explains this. It's. I mean, again, I'm being a shill here, and I'm selling the website, but it is true. Your question, Travis, is literally answered by the blog article that I posted, which is there, right, Ida? I think the link is there.
Yes.
Did I post it there? Okay.
Oh,
I think it's in the chat, right? Did it
I
post?
don't.
Yes,
Hold
it
on.
is in the chat.
Yes.
Yeah, it is in the chat. I see it there. I see it there. So Travis, but to answer your question, okay, basically the contribution year that you're declaring on your return is basically March 2nd to March 1st. That's essentially what you're declaring. Okay, so the first 60 days of 2021, you're declaring it as undeducted contributions if you declared them in the prior year. That's the only time you'd be able to claim them in the year. Otherwise, what you're declaring on your tax return is March 2nd of 2021 till March 1st, 2022. Those are the contributions you are declaring on your tax return for 2021. Okay, and again, go to the link. I think I posted it, but anyways, I'll repost it again in case. But literally, that article exactly speaks about your question, Travis. It's exactly about that.
Okay, our next question is from Anna.
Hmm.
She said she paid $575 in February 2022 for recognition of acquired competency
Hmm.
program at Champlain College that my spouse is currently enrolled, and she gives the website of where it is.
Okay.
No tuition receipt is provided. Can I claim what I paid towards the Canada training credit? I read somewhere that the school needs to be some sort of
Yeah.
government approved institution.
Yeah, first things first, Anna, you have to confirm whether it's considered tuition, okay, as a post-secondary education institution. Exactly, you're on the right path, Anna. First things first, you have to look up the school, okay, on the government website to see if they are what's called a recognized post-secondary educational institution. Okay, that's what you have to look for. Just Google that. Type in CRA recognized post-secondary educational institution. Just Google that directly, and then they'll provide the list. Try to find if Champlain is there. Okay, you have to find the school there. If the school is not recognized there, then unfortunately you can't claim it neither for the tuition, neither for the Canada training credit, because one goes with the other. Okay, first it has to be recognized as a tuition fee to claim the non-refundable tax credit in order for you to be able to claim it for the refundable credit, which is the Canada training credit. Okay, so they go together. So look that up. Google exactly what I mentioned before, which is CRA, a post-secondary recognized post-secondary educational institution. Look it up that way.
Okay, next question is from Tony
Hmm.
Zamet. I
Perfect.
join every session, and each session I learn something new. Oh, thanks. Okay. Sadly, mom just went into LTC. Can we claim the LTC care cost if we are paying for it?
Yes, yes, you can. It's considered, so LTC is long-term care. I'm assuming, Tony, in this case, so it's a long-term care facility. So in that case, yes, as long as you could prove that you paid for those fees, then they're eligible under your return. However, just be mind you could claim them as a medical expense. Okay, so you claim them directly in there. Just be mindful though that as an LTC, I'm assuming your mom is also eligible for the disability tax credit. Usually they go hand in hand when you're going to an LTC center. It's usually because the parent has become disabled at that point. You have to be mindful of this, that you can only claim one or the other and not both, meaning that you could claim the long-term care facility fees as a medical expense, or you can claim the disability amount that your mom can transfer directly to you, but you can't claim both. Okay, it's one or the other. Okay, that you can claim. Usually, the LTC fees are a lot more beneficial because they're quite high. Let's not kid ourselves. These long-term care facilities are not cheap. They're 2 to 3 thousand minimum a lot of times. So you're talking about practically 20 grand in fees. So usually the medical expense is more beneficial than claiming the credit, the disability tax credit.
Next one is AZ Jackman.
Okay.
How does one report money that they put in the stock market, aka
Mhm.
via Wealthsimple or something like that,
Mhm.
even if it wasn't very much money, like $50, for
Mm.
example. Also, if one has unused tuition, federal tuition, education, and textbook amounts, what does that mean?
Okay, so first things first, you only report when you sell. You don't report when you put money in. Okay, so if you're buying, you don't. The transaction is not a taxable transaction yet. It only becomes the taxable transaction when you've actually sold. So if it's in a taxable account, meaning it's not an RSP, it's not a TFSA. Okay, that you have with your broker, which in this case, in your example, is Wealthsimple. Okay, then in that case, when you sell the stock for a profit or a loss, is when you declare the transaction. But if all you've done is put in $50 as a contribution, then you don't declare it unless it's an RSP contribution. And then it's different than if you actually bought something in your RSP account. You made a deposit in your RSP account, then it becomes an RSP contribution that is deductible on your tax return. But if it's a TFSA or a taxable account, you only actually TFSA, you never declare it actually in the TFSA. It just stays there and there's no taxable transaction to declare. While if it's a taxable account, you only declare when you sell. You either declare the loss or you declare the gain. Okay, then the question was unused tuition textbook. What does that mean? So unused means that your tuition tax credit is what we call a non-refundable tax credit. And we actually just literally made a YouTube video about this, students and taxes. Okay, we literally just we explained the concept of the carry forward. Okay, but I'll explain a little. I'll sum it up here as well. Okay, essentially the way it works is these credits are non-refundable, meaning that if you have more credits than your federal tax or your federal and provincial tax combined, then the excess amount, unfortunately, you can't claim it as a refund. You don't get it back as a refund on your return. Okay, so now for some of these credits, the government allows you to bank them. Essentially, you're banking them, you're putting them in like a virtual bank, let's say, that you can use them in a future year when you're going to be taxable, because your non-refundable tax credits, you use them up until your federal tax. Anything beyond that, you carry over to a future year if you don't need it. And like I said, with non-refundable credits, you're not being reimbursed. That's why the government calls them non-refundable. Okay, so once you've created that excess amount, you carry it forward, and then in a future year, you banked these credits that you can use now and apply them against your tax in a future year.
Okay, next question is from Alex.
Mhm.
I am a small business, so I get dividend income. When I
Mm.
plug that in, the deduction is a lot more. Not sure if it calculates well.
Okay, so I'm assuming you have a small incorporated business and you pay yourself in dividends. That's what I'm assuming here. I'm a small business, so I get dividend income. That's what I'm assuming. You have a small incorporated business and you pay yourself in dividend income. If that's the case, then no, actually, dividend income gets a preferential tax rate. Okay, because you get the dividend tax credit that comes with it. That's one of the reasons. It's actually one of the incentives of incorporating and creating these incorporated businesses. Okay, that the government puts into the tax code. They want you to create a business. They want you to create incorporations. So to do that, they give you the option of paying yourself, instead of paying yourself a salary, to pay yourself in dividends. And dividend income always gets a preferential tax rate over employment income. So it's actually quite normal. To be honest with you, actually, I think if memory serves me, you can collect up to 50,000 and change of dividend income and not pay any income tax whatsoever. Okay, on your tax return. All right, if you have a small incorporated business, that's again one of the incentives that the government puts into the act for you to create yourself an incorporated business. So it could be quite normal actually in your case. Again, I don't have all the details of your return, but it could be quite normal.
Okay, and if he wants to check if the entries are done correctly, he needs to contact support
Mhm.
for them to review it with him.
Yeah, exactly.
Okay, next question is from Milena.
Elena.
Under the rental property section, how can I fill out area 4? I believe it's the 776 she's talking about.
Yeah, let me have a look at it 1 second, just to see which area. I'll tell you in a second once I look at it. And T776 area part 3, part 4. Where is it? Area. No, there's no. It's area C, D, and E. Area A. Part 4 would be the expenses. I mean, it's Milena, that's just standard expenses basically. So Milena, when you add the rental statement in UFile, you're gonna have an income and expenses section. Once you fill in the expenses
It's area
section,
A. She just typed in
area
an
A.
area,
Okay,
area
okay.
A.
So that's CCA. So that's CCA. I'm assuming. Okay, so then area A, yeah, that's your CCA. Okay, so that for that one, Milena, what you're going to do is when you've added the rental statement, okay, into UFile, there should be a section there within the rental that's called CCA. Okay, that's what it's called. So I'm just going into it now. Okay, so that's called CCA. Let me go into so Ida, I'm just gonna I'm gonna share my screen real quick
Sure.
and show it to Milena. Just give me 1 second. Here we go. Share screen, and we go here. All right, so I think we're both hidden right now. Okay, so when I've added the rental statement over here, you're gonna notice where I'm going. Can you see it, Ida?
No, no, I still see us.
You still see us? Okay.
Yeah.
Oh yeah, show and stream. Here we go. Okay, so now let's
You could
show it.
hide me for now.
Yeah, but you know what? They've changed the interface. Hold on. I can't share it as much. Hold on. Okay, I'm gonna hide you, Ida, for 2 seconds. Okay, here we go. Oops, other way. There we go. All right. So I'm just gonna hide the question so Milena, you could see it. So as you can see here, I'm in UFile right now. Okay, so you see I'm in the rental statement. Okay, so you see it right there. I'm in the rental statement right there. You have the identification income. You have a section called CCA. That's where you go. So you click on CCA right here. And then for a rental building, it's class one. Okay, at 4%. That's the one you're going to use. Okay, so class one at 4%. Click on the plus sign for class one, 4%, and just fill in the blanks. Okay, fill in the areas, which would be essentially you're entering what's called you would be entering in this case whatever it is, the value of the property. If it's an addition, if it's an addition in the new year, you would fill in the addition over here. If it's already an existing balance, you would put it in opening balance, and that's it. So just remember CCA section on the left-hand menu when you're in the rental property section, and then choose class one at 4%. Okay, that's what you would do. All right, so now I'm going to hide that. I'm going to show Ida back in the stream. Countdown, and Ida's back. Oh, hold on.
Oh no,
What
you
happened?
can skip that.
There you go. All right.
All right.
A little
Next
rusty
question
on
is
that
from
one.
Roger.
All right, Roger.
I am the
Perfect.
executor for my mother's estate. She passed in
Yeah.
2020. Sorry
Mhm.
for your loss.
Yeah.
And all of her income tax returns were done and her final return was submitted last year. I
Mhm.
recently received two income tax receipts, a T4A and a T4 RIF addressed to the estate of. So I expect I have to claim them on my return, but I don't know where.
Okay. Okay. So I'm the executive of the She passed away. Recently, I received to the estate of. Okay. The question, Roger, is who's the beneficiary of that income? That's the first question. Okay, because it's written to the estate of. But if you, the son, first of all, our condolences for your loss. If you, the son, are the beneficiary of the estate, then you are the effective. It's exactly right. You are the one claiming them under those slips. So you're going to add the T4A, you're going to add the T4 RIF, and you're going to follow the box numbers of those slips, and you're going to declare them on your return. Because if it's anybody other than now, actually, no, sorry, no, I'm wrong. I'm sorry. Scratch that, Roger. I'm sorry. If you are the child and you are the executive of the estate, then it is in your mom's return that these have to be declared, because your mom is assumed in this case to have withdrawn the funds of those accounts the day that she passed away, because you, the son, are the beneficiary of the estate. Okay, if it was, for example, a spouse, then the amount transfers over to the spouse tax free. Okay, normally. Okay, but since it is the son, in this case, it is in your mother's file that you have to declare them. It is considered as a withdrawal on the day of her death. Okay, and the income has to be declared in your mom's file. Okay, that's how that would work. Sorry about that. I just got confused there for a second.
Okay, next question is from Travis. He wants to know how to input my RSP receipts into UFile. I don't see it.
Okay, so okay, an item. I'm gonna hide you again.
Here,
Sorry about
don't forget
that.
there's two steps.
Yes. Show and stream. Here we go. Up the other way. There we go. All right. So, Travis, I'm going to hide your question so you can see better. Okay, so I'm back in UFile over here. The section is pre-filled by the software the moment you go in. The moment you're above 18 years old and you go in, you're going to see a section over here called RRSP contribution and limits. Okay, so you click on that where you see it right there. And this, by the way, you're not going to the interview setup. You don't have to go back to the interview setup to add that section. You simply go to RSP contributions and limits, and then from there, you've got your contribution days, as you can see here, March to December 2021, and for 60 days, exactly as I described it, March 2nd to March 1st. Okay, that's what you're declaring on your Schedule 7 on your tax return. So again, just look at your left-hand menu in your file, and towards the bottom, you're going to notice a section called RSP contributions and limits. Simply go in there. All right, so I'm going to hide, show Ida back in the stream, and there we go.
There we go.
Ida, you're back. There
I
we
am.
go. All
Okay.
right, next.
Next question is from John Ferrari.
Mhm.
How does CRA determine income for CRB? Is it when income was earned for that tax year to be included, or must the income earned and received in the same year? In my case, I receive bonuses which are accrued in the next year.
Nor well, I don't know. I don't know about the bonuses. I don't know where that comes from with the CRB because that usually does not is not affected by the CRB at all. But John, essentially, what the way it works is it's when it's received. Okay, so it's really the government considers it on a cash basis instead of an accrual basis. Okay, that's how the government usually deems the tax return. That's how they determine the tax return. So in this case, it is when you actually receive them. I'm not sure about the bonuses because that usually is not included with the CRB, but it's really when it was received. Okay, not when it was accrued. Okay, that's essentially how that works.
Next question is from John Watson.
Yeah.
I don't understand Schedule 14, Climate Action Incentive. Do you wish to claim the Climate Action Incentive line 45 110? Also, let Max back decide. So,
Okay, so the climate action. So first of all, there's a change with the climate action incentive, which we mentioned again on our blog article with tax changes. We mentioned it that first of all, it's a benefit now; it's no longer a credit. All you're doing on your tax return is declaring whether you live in an urban area or a rural area. If you live in a rural area, you get a 10% supplementary amount for the benefit, but that you have to declare it on your Schedule 14. That's what the program is asking you. Okay, so first question the program is asking you is, are you eligible? The answer is yes, as long as you live in one of the provinces that are affected, which I believe is Ontario, Manitoba, Saskatchewan, and Alberta. I believe are the four provinces that are affected. Essentially, that don't have that the government basically includes the climate action incentive. So if you live in a rural area, you have to answer the question in the software to tell the government that you live in a rural area, so you can get the supplementary 10%. Otherwise, you say yes, and then you say no. If you live in an urban area, you say you live in an urban area, and then you don't get the supplementary amount, and you won't get Schedule 14 that will appear in that case. But that's the reason why the program's asking you. It's trying to get you the 10% supplementary amount if you live in what the government considers as a rural area instead of an urban area. That's why.
it's sort of a reminder
Yeah,
to
and
answer the
it's actually an
question.
obligation. If you live in a rural area, you have to answer that question. You have no choice.
Okay. Next question is from Milena.
Mhm.
If I have unappreciated capital costs from a previous year, how can I fill out areas A, section 2, 6, 10, and 13?
If I've underappreciated capital costs, okay, I'm assuming it's column that you mean. It's column two under. Okay, so again, so I'm going to share the screen again. Sorry,
Sure.
Ida,
Go ahead.
I gotta
I know
hide you again.
you want the glory. Go ahead.
No, no, I need your help. I did this alone in French last time, and whatever hair I had left is basically all gone now. So hold on. Hide, show and stream. Okay, and there we go. All right. So Milena, what you have here, first of all, okay. So column two is this one here. Opening balance of undepreciated capital cost. Okay, that's your column two. Okay, that's where you input. Let me hide the question so you see better. Okay, so that's where you input that amount over there. Okay, so that's in column two. All right. Now, for the other columns, they'll be calculated automatically by the software, depending on if you want to claim CCA or not. Okay, so it all depends. It all depends on that. Okay, so if I'm looking, like for example, at the rest of your questions here, which would be six after additions. Okay, so that would be a purchase. What was your other ones there? You had 6, 10, and 13. So 10 and 13 are automatic. Okay, so there's nothing for you to do. For 6, which is you need an addition. Well, for 6 it'll be automatic actually, depending if you have additions or not. Okay, so if you only have 2, which you didn't mention anything about 3, which means you don't have additions. So every other one will be automatic calc. Okay, as long as you fill in the 2, which again is this box right here. So the program will compute the CCA or the depreciation cost automatically for you. Now be mindful though, okay, be careful. It might not be the greatest of ideas to claim CCA for these properties. Okay, because as we see right now in the marketplace, these properties have really taken up fire, right? They've really picked up in value. So if you sell this property later on for a profit, whatever you're claiming as the depreciation cost, you'll have to re-include it back as income on your tax return the year that you sell. So be very, very careful. If you don't want to claim CCA, if you don't want to take the depreciation expense because you might have to pay it back later on, okay, then you have the section, the line, excuse me, limit to the CCA of this class. Okay, so you're limiting, so you could put in 0, for example, in that box, and it won't take any CCA. All right, so let's bring Ida back. And here we go. And Ida's back. There we go. All right.
Next question is from Suzanne.
Mm-hmm.
If you transfer to a RIF to an RSP, you get a T4 RIF with taxable income. Do we
Yeah.
deduct this amount somewhere so it doesn't count as income? Do we put the amount from box 24 excess amount in new file?
Yeah, well, it all depends on how you made the transfer. If it's an account transfer, then it wouldn't be taxable. You should have a slip or a receipt that indicates it's a direct transfer. But if you pulled it out cash and then you put it, and then what's called, you put it in an RSP, then it is taxable income. At that point, you have to declare it on your return. So it all depends how you executed that transfer. Okay, is it an inter financial institution transfer, or was it they gave you the cash and then you put it in an RSP account? Then in that case, unfortunately, it's taxable income. The box 24, yes, you can. When you enter the T4 RIF, there is a box 24 there usually from the software. Let me just confirm that. Actually, maybe I'm wrong. Since you're asking the question, I could be wrong on that, but I'm pretty sure 24 is there. Yes, so 24 is there. It doesn't really affect any of your calcs. Is just to indicate to the government that you've taken more than what the minimum amount that you were required to take was. So basically, what was the excess amount you took above the minimum amount that you were required to take out? That's essentially it's just information for the government.
Okay, next one is not a question. Keith just said he would like to see you file add expected GIS payments for the next year.
Hmm.
That's some
It's a
something.
good suggestion, Keith. That would be a nice info to have. It's not, yeah, yeah. So I mean, we'll transmit it to our programming team, see if we can do something with that.
Okay. Travis asked, what do I put for issuer name on UFile's RSP section? Do I put a separate one for me and my employer group RSP?
Well, your employer should already be. Well, you shouldn't be putting anything for your employer. You should only be putting whatever you put in, right? So you put in, yeah. You could just put in your employer number or whatever the financial institution is that they use. Do they use some sort of financial institution to manage those funds for them, right? I mean, I know. With us at Thomson Reuters, we have a financial institution that handles our pension plan contributions, right? So just put them put the name there. Just mind you, when you transmit to the CRA, they won't see that information anyways. Okay, so they're not going to see that either way. Okay, so when you transmit it, because it's not an information that shows up on Schedule 7, okay, that you're transmitting to the CRA, so you don't have to worry about the name.
Next question is from Pedro. How do
Mhm.
you carry forward the previous year's loss?
Um, Well, it carries forward automatically by the software. I'm assuming Pedro, you're talking about capital losses in this case. They carry forward automatically. You just got to put them in the right spot. So in this case, again, Ida, just give me 2 seconds. I'll just show
Go
it in the
ahead.
stream, and I will hide and go right here. All right. So in the interview setup, okay. So when you go here to the section called the interview setup, you should have a section here, which is for losses right here. So see at the bottom, completely at the bottom, you got losses of prior years carrybacks. So tick that box. Hold on, I got my coworker here texting me. So let's keep going there. So let's click over here, and from there, you're going to see the section appear here on the left-hand menu called losses of prior years carrybacks. So you click over there, and then you got your section called net capital losses of other years. Click on the plus sign right there, and from there, you simply plug in the year and the amount that you're carrying forward. So we have an instructional video on our YouTube page as well on how to do this. Okay, so it's right there as well. Okay, so let me just close this here. All right, and there you go. All right, so let's bring Ida back. Show and stream. And there we go.
Okay, next one is from Joy. I
Mhm.
missed claiming for my eyeglasses in previous years. Can I still claim them in this tax year? I am
Yeah.
also going to claim one for the tax year 2021.
You can't. No, it's date dependent, which means you have to adjust your previous year for 2020. Okay, so that's what you can do. You can't take the 2020 expenses and claim them in 2021 because you have forgotten them. You know that doesn't work. Because if you get audited, the government's going to refuse them. Okay, very simply put. Okay, if you get audited, so your best bet is to create an account with my with the CRA. Okay, my account. Okay, my account with the my account portal, the CRA, and then go through their adjustment system. Okay, they have a really nicely done adjustment area where they basically show you the amounts you declared last year, and then ask you what you want to change amongst those amounts. So it's a column of what you declared, and then a column with your new amounts. Declare the glasses there. Send your adjustment, and the CRA will adjust then for your 2020. That's the legal way of doing it and the best way of doing it as well.
Now, our next one is from Suzanne Sylvester.
Mhm.
Schedule 5, amount for spouse. The top paragraph talks about impairment. Can you still claim some amounts for spouse even if not disabled?
Yes, but there has to be an impairment, which unfortunately the government does not make clear what they consider an impairment. Okay, they basically mean some sort of difficulty that they have that you are taking care of them. Now you don't need a disability certificate to claim, for example, the additional caregiver amount on the spousal amount, which I think it's a supplementary $2,300 that's added to the credit. Okay, to the spousal amount. However, you do need an impairment. So you need some sort of note from the doctor that indicates that the person has some sort of physical ailments, okay, that you are helping them with. Okay, but you don't need to go to the level of disability. That's true. You don't need to go to that level, but you do need some sort of letter from the doctor saying that there's a physical ailment that the person has, and that you're helping them with, and then you can make the claim for the caregiver supplementary amount, which is added to the spousal amount.
She's also asking, do we click yes to caregiver amount if the spouse who is disabled is the one who has the higher income?
Yes, you still claim it. If they're entitled to disability, they're entitled to disability tax credit, which is quite a big credit actually. It's about $8,000 at a 15% clip. You're talking about a good almost $1,200, right? Of a tax reduction on your return. So you still answer it. Yes, you're still now. Yeah, that person is not claiming the caregiver amount, but just make sure that you indicate that they're eligible for the disability amount. Just make sure that you.
Oh, I think we lost. I think Jerry froze. He's going to be right back to answer your question, Suzanne. Okay, you're back.
Yeah, I'm back. All right.
Okay.
All right. Sorry about that. So let me specify again. The caregiver amount. You're right. No, you wouldn't answer yes because it's not. You want to claim that person for caregiver. They're not the ones claiming the caregiver amount. So you would say, but make sure that you indicate there's a disability there. Make sure you indicate that you're claiming the disability amount for them. Make sure of that. Okay. So make sure you're doing that.
Next question from Sean. Hello, I was wondering how far back I can use capital losses against capital gains. Are there specific forms to complete?
Okay, so if it's a current year loss that you want to carry back, okay, then it's 3 years back that you're allowed to go. If it's a current year loss, okay. The moment they're carried forward, though, it's too late. You can't go back unless you want to adjust. Then you have to actually adjust your tax return. But if in this case it's a current year loss and you want to carry back to previous year, then in that case it's 3 years back that you're allowed. The way you do that is through a specific form, which is the T1A. Okay, that's the form that you have to use. All right, so it's the T1A form that you have to use in order to claim the carryback of those losses. Okay, so it's T4A. So you go back to that section that I was showing you that I showed before when I answered the question, which was the losses section in this case, and then from there you indicate a carryback. Okay, you choose the option for the carryback, and then you make the carryback of the loss there.
Thank you, Andre, for posting in the comments the RSP deadline blog
Mm.
also. Thanks.
Thank you,
Uh,
Andre.
we did Sean, Suzanne,
So I think we're at Anna now.
Anna.
Yes.
Just to confirm, is this the website to search for the approved list of institutions? She gave a website if you're
Okay.
able to copy and
I
paste.
can't copy and paste. Can you do it? Can you do it, Ida? Because for my system, I can't do it, unfortunately.
Okay, hold on a second. Let me see if I
But,
can
but we
pull
could
out.
confirm. But we could confirm like at the end of the session. Unfortunately, I can't. Wait. Let me hide the. Maybe I could do it by hiding it. No, I can't grab it with the system I'm using right now. Unfortunately.
Okay, I believe it is the correct. It brings you to the CRA website, and it
Hmm.
says list of certified institutions.
There you go. Yeah, that sounds about right, Anna. That sounds about right. And just
And
look for that college. Look for that college and see
yeah, and
if
you
they're
could
in there.
search by names, or there's a list by province.
Yeah, exactly. Perfect. All right.
Okay.
Next, I think we got Roger. Huh?
Next one is Roger.
All right.
Okay, retiring in the next couple of years, planning on living in the Caribbean's beach for
Lucky
six
you.
months, minus a
Lucky
day
you.
in winter, and 6 months plus a day for Canada
Yeah.
for summer. Can the Canada part be in a RV on a property I own with a hookup with a well and septic
Yeah.
tank and a civic address?
Yeah.
Can this be considered
Yes.
principal residence?
Actually, the answer is I believe yes. Let me go to my document here. An RV can count as a housing unit. What the government considers under the definition of a housing unit. I'm just going to check my notes real quick because I give this course on the professional side and I have the definition of a housing unit. Just give me 1 second, and we're going to try here. Just Okay, so let me go here. Let's try. I believe it's in my campaign one. And I'll confirm that for you, but I believe the answer is yes, Roger. I believe the answer is yes for that one. So let's check. What does the government consider a housing unit? So a housing unit is a house, yeah, a mobile home, a trailer or a houseboat, lease interest. Yeah, so the government would consider that as a home. It would because it's a mobile home. So that's a term that the government uses as a mobile home. So yes, you would be eligible in this case.
Next one is from Doug. Is there a site I can visit to get details on how to close a small business and do the final tax return, an incorporated business?
That's a good question. Doug, unfortunately, I don't have the answer. I could try to research it, maybe post it in the chat afterwards, but offhand, I really don't. I don't know if the CRA has anything on their website, but I'll do some research on it and see if I can find something for you, and then we'll post it as a reply, okay, to your question. All right.
Okay, next one is from John.
Mhm.
Can you get a tax credit for the 15% withholding tax when US collects from dividends within TFSA?
No, no, unfortunately, you cannot. No, because of the fact that the income is, remember, the foreign tax, the purpose of the foreign tax credit, okay, is to give you credit for the fact that you're about to pay Canadian tax on this income, right? So what the government is doing is that the federal government is reimbursing you the foreign tax so you can pay the Canadian tax on that income. But since it's in the TFSA, it's not subject to Canadian tax, therefore is not subject to the foreign tax credit. But just be aware it's still a winning deal, okay, because you're paying 15% tax on that income. Remember that dividend, if it was in a taxable account, you'd be paying the same taxes you would pay for employment income or interest income. Remember that US dividends are not eligible for the dividend tax credit that is offered for Canadian dividends, okay, so they don't get a preferential tax treatment. They get charged fully on your marginal tax rate, so you still come out a winner because it's likely that your marginal tax rate is well above 15%, okay, on your tax return. The better option in this case, if you want to avoid the 15% withholding tax, is buy these shares in an RSP account, not in a TFSA account, okay, because there is under the tax treaty between Canada and the US, there is no withholding tax on US dividends if the US dividends are held in an RSP account. So if you want to completely avoid it altogether, but then remember, when you pull out that dividend afterwards, it becomes taxable income though on your Canadian return. Okay, while with the TFSA, you pay 15% on the U.S. tax, but you pay nothing when you withdraw the funds.
Next question is from Keith. My download of tax slips from my account included an unknown T5 from Sun Life, he says,
Mm.
for interest income. How can I find out the original source of the income of the T5 is reporting? Should he call the Sun Life or the CRA?
No, it's Canada Life. You would have to, if you want to figure out where that amount came from. CRA is only giving you what it's been given. The CRA has no clue why you got that amount. You have to call Canada Life directly and find out where is this amount from, what account is it that you're not aware of. So call Canada Life in this case.
Okay, next question is from Suzanne. When you select split
So.
pension, it seems weird that some of the income goes on the higher income person. I had to print a reconciliation report and I guess it makes sense. Is there a
Mm.
reason you would not click that?
So, okay, so you're splitting pension, and in this case, the pension is actually going to the higher income spouse, is what's happening. The reason I could think of is to get the pension income amount credit. That's the one reason I could think of. For example, the higher income spouse does not have any other pension income, and by splitting a certain amount, and depending on their income level, the credit, getting the pension income credit outweighs the additional tax they would have to pay. So that could be a reason why that might happen. But with pension income amounts, with pension income splitting, you really need to file, to really look deep down to see whether it's beneficial or not. So beyond seeing the file, just off the top of my head, that's one reason I could think of why the program is doing it. If not, you have to contact us,
Mhm,
and you have to contact our support line and see support agent can look at the file and see what's going on.
mhm. Could it be sometimes it's trying to keep one spouse below the next tax bracket?
Yeah, but if I'm adding income, I'm not in this case, right? I'm
No,
actually
no,
pushing
for
them
one of
further.
for the two
Yeah, that
spouses
could
not
be
to be
it.
the same,
Yeah,
one
you're
in
right.
the higher, one in the lower.
Yeah, yeah, yeah. It could be if they're at the same level. It could be that as well. But again, there's so many factors that could be involved in that. With pension income splitting, especially.
Okay, Nikwi,
Hmm.
if the principal resident is in Ontario but you live in Quebec, be what should the identification address be?
Identification is going to be whatever is the Ontario one. No, that's the one you're going to have to use. I think the government asks you for a lot number, I believe, on the provincial side, when you're declaring the principal residence. That when you're doing the principal residence designation, I believe that's the provincial government is asking you for that. If memory serves me, you would have to use the address of Ontario. It doesn't matter whether it's in Ontario. If you're a resident of Quebec, if you live in Quebec and it was the principal residence, because a secondary home in this case can count as a principal residence, by the way. Again, when the government says ordinarily inhabited, it means that you live in it at some point in the year. That's all you need to designate that property as a principal residence. And of course, you're not renting it. You're not using it for a business purpose. That's the other criteria in that case for a principal residence. So no, you would use whatever the identification of Ontario is. That's what you would use.
Okay, next question is from Keith. I moved
Mhm.
from BC to Alberta last year. I have self employed income in Alberta. I understand
Hmm.
I can claim moving expenses against the self employed income in Alberta. My expenses are greater than the income. Can I create a negative income, a loss?
Yes, but you're claiming. Remember, you're not claiming moving expenses, the deduction. You're claiming your moving expenses as a business expense. That's what you're doing in this case. Okay, so you're moving because you want to move your business to the other place. So in that case, you're claiming those expenses against your self-employment income, not the deduction or the T1M form. That you cannot. You can only claim that one for against employment income, not against self-employment income. So what you're doing here is you're going to claim the moving expenses against your self-employment income in this case. Okay, that's what you're going to do. Okay, and yes, you can create a negative amount. You can, because the move, if the cost of the move to create your business in Alberta was more than your income, then yes, you have a business loss, and which will become a non-capital loss, which you can use against any other income on your tax return. And if there is no other income on your tax return, then you are carrying it forward to a future year.
Okay, now John, he's asking, can you claim the 15% US withholding tax on the US dividends from a US TFSA
No,
account?
no, it still doesn't work. No, it doesn't work, John. It's because at its base, the income is tax free in Canada. So the government is not going to give you credit. Remember, the purpose of the foreign tax credit is to give you credit for the fact that you paid a foreign tax. In other words, it's to alleviate double taxation. But in this case, you don't have double taxation. You're not going to pay any tax in Canada. You're not paying anything there, right? So the moment it's a TFSA account, it's tax free. You just can't. Like I said, if you want to avoid that 15% withholding tax, RSP. That's the only way you could do it. Otherwise, like I said, it's still a winning deal. It's still a winning deal because you're only paying 15% tax, while if you had it in a taxable account, you'd be paying much more than that. So it's still a winning deal in this case.
And he also has another question. Is selling at a loss in my margin account when buying at a higher price within 30 days in my RIF or my TFSA technically legal since they are different accounts?
Selling at a loss in my margin account. Okay, so you borrowed to invest in this case. Then buying at a higher price within 30 days in my RIF or TFSA. Okay, so I'm assuming the sale was in a taxable account. That's what I'm going to assume in this case. If you did it within 30 days, then no, you cannot claim. You cannot claim what's called in this case you cannot claim the loss. You fall right into the definition of superficial loss. It doesn't matter if it's a different account. It's the sale and the purchase follows you, the person, not the account. You understand? So in this case, if you sold it from a taxable account and bought it within 30 days in what's called within 30 days in an RSP or TFSA account, unfortunately the loss is not applicable. You can't. You fall right into the superficial loss, which I believe again we have an article on that in our UFile blog. I believe we have an article about that as well. So unfortunately, because you did it within 30 days, you lose it. Unfortunately, the key is the strategy works. What you were trying to do there actually makes sense, but what you should do is wait the 30 days. If you wait 30 days and you buy and you repurchase it in one of those tax sheltered accounts beyond the 30 days, then you've just locked in your capital loss. Now you're allowed. But because you did it within 30 days, you fell right into the superficial losses rule. It's right in there.
Okay. Next one is John. Are
Mhm.
dividends from a small business corporation considered to be non
Mm.
eligible dividends for purposes of self employment income calculations towards a CRB limit? But bonuses you stated earlier are not counted towards self employment income for purposes of
So the
CRB
CRB
limit.
limit. Okay. So no, now it's a little clearer. Are dividends from a small business corporation considered to be non-eligible dividends for the purpose of self-employment income? It's not considered self-employment income, John. So the problem is going to be if you're if you're paying yourself in dividends, Okay. And remember, the CRB, the eligibility criteria was that you had to have at least $5,000 of employment or self employment income. You had to have at least that. Dividend income does not count in that 5,000. Okay, dividend income. Now, the bonus in this case, if it's considered as a bonus for your employment income, and you're considering and you're including the bonus as employment income, then yes, that counts for the CRB limit. That does count then. So I misunderstood your question before. Okay, so the bonus would count, but the dividends would not. Okay, because again, you could have chosen to pay yourself an employment income over dividends. In a sense, so the government is not going to get, even though you've worked for the income. I mean, you have a small business, it doesn't matter to the government. You could have chosen to take employment income over dividends. So the dividend does not count, but the bonus would, as long as the bonus is considered as employment income.
Okay, Suzanne has a follow-up question to
Mhm.
the RIF, the T4 RIF received for transfer to RSP. Do we ignore the RIF if the T4 RIF if it was transferred directly, or do we put it in income and then deduct it under RSP? Will the investment company send the RSP deduction slip?
They should. So in this case, Suzanne, if listen, normally if it's an inter financial institution transfer, you should not. There should not be a slip. There shouldn't have been. If you do have a slip, then you need the corresponding receipt. You have to have a corresponding receipt slip from the financial institution that says it's a direct transfer. Okay, and it'll mention a specific article of the law, which is usually subparagraph 60L, if memory serves me, of the Income Tax Act. Okay, so that's what you need. Yeah, you do need a corresponding slip. Otherwise, the government simply sees it as a taxable slip. They won't know the difference. Okay, so you do need a corresponding RSP receipt.
Okay, John, I hope we did answer your question. I know you asked the same thing, but with a 50% CRB limit. I hope you're clear on your answer regarding the self-employment
Mhm.
dividends and all that. Suzanne, no, sorry. Travis, does UFile automatically apply for the low-income family tax credit if you're eligible?
Yes, I believe it does. Is that Ontario? I can't remember which province exactly, because there's a couple of provinces that offer that. But yes, normally the program will apply for that automatically. There's nothing else you need to really do in the software at the moment the income, because the credit itself is basically below a certain income threshold, right? So the moment you meet that income threshold, the program will simply apply it.
Suzanne has another question. My
Hmm.
dad passed away 2 years ago. My mom did the final income tax for him. We
Mm.
received a T5 in his name last year. It was an insurance company who was sending shares when they merged. Would my mom put the amount on her tax return or ignore it since he passed away?
2 years later, wow. So yeah, that's a really good question, Zen. On that one, I'm not sure. I would be tempted to say the estate should pay through a trust return. That's my first instinct as far as the answer, but I'm honestly not sure. I'll have to do a little bit of research on that one. I'm really not sure on that one. I'll have to do a little bit of research.
Okay, John,
Hmm.
is there any reason to keep track of my ACB and capital gain for stocks within the TFSA or RIF?
No, there's really no reason because you're not a TFSA. First of all, is tax free. So when you make your withdrawals, it's tax free. Doesn't matter. For the RIF, any gains you make within the RIF are tax sheltered. What you get taxed on is the dollar amount of the withdrawal you make from the RIF account. So it doesn't matter what the gain was. All they say is, okay, you pulled out $5,000. It's $5,000 of income. Doesn't matter how you got it. It's just the fact that you pulled it out. Okay, that's all they're going to check. So no, you don't have to, unless you want to keep it for your own records to see how you're doing with your own account. But as far as the tax return is concerned, no, there's no need for it.
Okay, I
All
think that
right.
concludes all our questions for today.
Yeah.
And actually, we're over the time
Mm.
by not much this time. That's pretty good.
Mm.
So that really concludes our Facebook Live session for today. So, very important, our website, www.ufile.ca, has a lot of information. You have access to our YouTube channel, our blogs, um, Tax in You, which has
Podcast.
and our podcast, which has also some nice tips and tricks. So, Jerry, anything you want to remind everybody?
Yeah,
Tax deadline, everything else?
yeah, so tax deadline will be since April 30th falls on a weekend, it's actually going to be. Let me just check exactly the date.
May
It'll be
2nd?
actually May 2nd. Yeah, so our deadline is May 2nd this year. Okay, because April 30th falls on a Saturday, so usually it always defaults to the month to the next weekday. Uh, there's also our YouTube page. Don't forget that our YouTube page has a lot of videos, a lot of content. Um, what's called it has a lot of content that give you so for example a lot of the questions that you guys asked today, we actually have videos for them, on our website. Losses carried forward, like for example, how do I do loss carried forward in the software? We have a video for that. The principal residence, it's coming. I'm going to do a nice review of through our Let's Talk Tax video series, that we're going to do, which we've already done
Mhm.
2 of them. And we're going to do some more. We're going to be in full expansion on our YouTube videos. We also have our podcast, where we talk about a lot of interesting. For example, we just did students and taxes, right? We just posted it
Mhm.
on YouTube and on the audio podcast sites as well, where we talk a lot about the Canada Training Credit and about the tuition credit. What can students claim, right? So a lot of it is in there as well. So don't hesitate to go through our content. We're doing this for you, so you get additional information, and we're handing it for free. I mean, we're just giving this information for free. So grab it. Go ahead and grab it and do what you will with it, and be more efficient with your taxes.
And if you have suggestions, we'll take them.
Yeah,
So,
absolutely. We're always looking for content. We're always looking for topics, right? And actually, the topic of the principal residence, we got it from a customer, from a viewer. Actually, I said, "Hey, it would be great if you did principal residence," and we decided
mhm.
to take it. We're gonna take it on and do a video.
All right. So thank you very much, Jerry. We'll invite you next time for our next Facebook session. Just keep
Yep,
watching our Facebook page. We'll post it when we're ready to do a next one. So thank you,
perfect.
everybody. Have a
Thank you,
great
everybody.
day.
Take care.